Picture two guys, same age, same paycheck, same city, same $50,000 sitting in a bank account, doing absolutely nothing. One of them buys a rental property. The other one dumps everything into index funds and never looks back. 20 years later, one of them has more money, less stress, and more freedom. But here's what's wild. It's not the one you'd expect. And it's not as simple as a winner and a loser. It's much more complicated than that. I ran the full numbers, not the pretty YouTube thumbnail version, but the real version. Let's get into it. To make this fair, we're going to build a real scenario, not a fantasy one. Meet Daniel and Marcus. Both are 30 years old. Both earn $55,000 a year at a regular 9-to-5. Both have been disciplined enough to save $50,000, which, let's be honest, already puts them ahead of most people their age. Same starting point, same city, same financial energy. The only fork in the road is what they do with that 50 grand. Daniel decides to become a landlord. He uses the $50,000 as a 20% down payment on a $250,000 three-bedroom home in a solid neighborhood. Not fancy, but not rough either. The kind of street where people mow their lawns and neighbors wave hello. He locks in a 30-year mortgage at 7% interest. His monthly payment comes out to roughly $1,330. He finds a reliable-looking tenant who agrees to pay $1,800 a month in rent. On paper, that's $470 in his pocket every month before a single bill arrives. Daniel feels like he cracked the code. Marcus, on the other hand, doesn't want the headache. He puts the full $50,000 into a total stock market index fund, a simple, low-cost fund that tracks thousands of companies at once. He sets up an automatic $300 monthly contribution, turns on auto-invest, and essentially forgets it exists. His coworkers ask him what he's doing with his money. Index funds, he says. They nod slowly and change the subject. Nobody's impressed. There's no story to tell. Here's what's interesting, though. One of these decisions feels like winning, and one feels invisible. But feelings are not math. And over 20 years, math is the only scorekeeper that matters. For the first couple of years, Daniel is living exactly the life he imagined. Rent hits his account on the first of every month like clockwork. He drives by the property on his way to work and thinks, "I own that," with a smile. He's writing off mortgage interest and property depreciation at tax time, shaving a couple thousand off his tax bill. He's watching homes in the neighborhood quietly inch upward in value. It's tangible. It's real. He can see it, touch it, brag about it. Year 1, year 2, year 3. Rent rolls in. The mortgage chips away. The equity builds. He feels like a genius. Now let's look at what the numbers actually say at the 3-year mark. Daniel collected roughly $64,800 in total rent over those 3 years. His mortgage payments totaled about $47,880. On the surface, that's over $16,000 in gross profit. Sounds great, right? Here's where it starts to sting. Property taxes, roughly $3,000 a year, $9,000 over 3 years. Insurance, about $1,500 a year, $4,500 over 3 years. Water heater replacement, $1,200. Roof leak repair, $2,800. 1 month of vacancy between tenants, $1,800 in lost rent, plus $600 to clean the place up and relist it. And Daniel manages all of this himself, because hiring a property manager eats 8–10% of the rent immediately. So instead, he's fielding calls at 10 p.m. He's skipping his lunch break to coordinate repairs. He's spending Saturday mornings showing the unit to strangers. After everything, the real costs, not the napkin math, Daniel's actual net cash flow over 3 years sits somewhere between $2,000 and $4,000 total. That's not a month. That's 3 years. Marcus, meanwhile, has done essentially nothing. He opened the account, set the contribution, walked away. At year 3, his portfolio looks like this. The original $50,000 plus $10,800 in contributions, all growing at an average annual return of around 10%. His balance has climbed to roughly $76,000. He didn't patch a roof, he didn't call a plumber, he didn't replace a water heater, he didn't screen a single tenant. He just waited. Now here's the important thing, and I want to be fair here. Daniel still has leverage working hard in his favor. That $250,000 property has appreciated maybe 3 to 4% per year and is now worth around $270,000 to $280,000. His equity, the gap between what the house is worth and what he still owes the bank, is somewhere between $55,000 and $65,000. That is real, legitimate wealth. And it was built partly using borrowed money. That's the power of leverage. It's the thing stock market investors simply can't replicate easily. Daniel's $50,000 controlled a $250,000 asset. Marcus's $50,000 controlled exactly $50,000 worth of assets. But leverage is only a superpower if it doesn't crush you first. Let's pause the story here because there's something we need to dig into. It's the stuff that nobody puts in the YouTube thumbnail. The $470 monthly profit Daniel sees on paper, it's not a profit. It's a starting point. Before you keep a single dollar, several things have to come out first. Vacancy. Almost every rental property sits empty for roughly 1 month per year on average. That doesn't sound like a lot until you realize your mortgage doesn't pause. You're paying $1,330 out of your own pocket for a house that isn't generating a dime. And while it's empty, you're paying to clean it, list it, screen applicants, and show it. Maintenance and repairs. A standard rule in real estate is to budget 1 to 2% of the property's value per year for maintenance. On a $250,000 home, that's $2,500 to $5,000 every single year. And that's for a place that's in decent shape. Some years it's a $150 faucet fix. Other years it's a $7,000 HVAC system that dies in August, and your tenant is threatening to call code enforcement if you don't fix it by Thursday. Capital expenditures. This is the one that blindsides new landlords. Roofs last 20 to 25 years. Furnaces last 15 to 20. Water heaters last 10 to 12. These aren't maybe costs. They are guaranteed future expenses. They come in chunks of $5,000 to $15,000. If you're not setting money aside every month for these, you're not running a rental business. You're gambling with borrowed money. Property management. If Daniel hires someone to manage the property, that's 8 to 10% of monthly rent, roughly $150 to $180, gone before he sees any of it. If he manages it himself, he's working a second job with no hourly rate, no PTO, and no off switch. And then there's the nightmare scenario. Bad tenants. A tenant who stops paying and knows how to work the eviction system can string you along for 3 to 6 months, no rent, full mortgage, legal fees, and eventually, the cost to clean up whatever mess they leave behind. One bad tenant situation can erase an entire year of profits, sometimes more. None of this appears on the thumbnail. All of it appears in reality. By year 5, Daniel isn't living the landlord dream anymore. He's living the landlord reality. He's on his 3rd tenant. He replaced the roof for $8,500. He dealt with a surprise plumbing emergency that cost $1,400. He had the property sit empty for a full month between tenants during one of those transitions. He raised the rent to $1,950, which helps. But his property taxes and insurance went up too because they always do. When Daniel actually calculates his cash-on-cash return, that's the money he's pocketing compared to the money he invested. He's somewhere between 3 and 5% after real. Expenses. Not bad, honestly. But it's nowhere near the 15 to 20% figure he floated to friends at a cookout 2 years ago. Marcus, on the other hand, is still doing the same thing he was doing on day one. Absolutely nothing. By year 7, his portfolio has quietly grown from $50,000 to somewhere between $135,000 and $150,000, including his consistent $300 monthly contributions. Here's what's happening beneath the surface that most people don't understand about compound interest. It's slow in the beginning, and then it becomes almost violent. In the early years, you're mostly watching your contributions grow. In the later years, the growth on your existing gains starts to dwarf your contributions entirely. The snowball stops being you pushing it uphill, it starts rolling itself. Daniel's wealth is growing, but it grows like manual labor. He earns it every month. Marcus's wealth is starting to grow like a machine. Nobody's operating it, it's just running. 10 years in, let's see where everyone stands. Daniel's property is now worth roughly $335,000 to $350,000. He still owes about $166,000 on the mortgage. That gives him equity in the neighborhood of $170,000 to $184,000. But here's the full picture. Over 10 years, after accounting for every real cost, mortgage, interest, taxes, insurance, repairs, vacancies, capital expenditures, Daniel has put in an additional $20,000 to $35,000 beyond his original $50,000 down payment. So his total investment in this property is actually closer to $70,000 to $85,000. His equity of $170,000 plus is still a strong return, but the gap is narrower than the headlines suggest. Marcus's portfolio, with the original $50,000, consistent $300 monthly contributions, and roughly 10% average annual returns, is sitting at approximately $165,000 to $180,000. His total out-of-pocket, $50,000 upfront, plus $36,000 in contributions. $86,000 total. The rest is compounding, doing its job while Marcus watched Netflix. At the 10-year mark, they're surprisingly close. Daniel might have a slight edge due to leverage. Now, I'd be doing you a disservice if I only looked at real estate's blind spots, because index funds have real, serious risks too, and they often get glossed over. Volatility is brutal and personal. In 2008, the stock market dropped roughly 37%. In March 2021 month, it fell about 34%. If Marcus had $150,000 in his account and watched it fall to $95,000 in a few weeks, that's not abstract. That's panic territory. And the data shows most everyday investors don't hold through crashes. They sell at the bottom and buy back in at the top, turning a temporary loss into a permanent one. There's no monthly income. Daniel gets a rent check. Marcus doesn't get a check. Index funds pay dividends, but on a broad market fund, that yield is maybe 1.5 to 2%. On $150,000, that's roughly $200 a month, not life-changing. No leverage. Marcus used $50,000 to control $50,000 in assets. Daniel used $50,000 to control $250,000. In a rising market, that difference in scale matters enormously. It's a key reason real estate creates more millionaires in many studies and surveys. No depreciation advantage. Real estate investors can legally deduct the theoretical wear and tear of their property from their taxable income, even when the property is actually going up in value. It's a tax shield Marcus simply doesn't have access to outside of retirement accounts. Stocks are not the easy, risk-free choice. They're a different kind of risk, a quieter one that can still break you if you're not mentally prepared for it. 20 years later, this is where it all lands. Daniel's property is worth somewhere between $450,000 and $500,000. His mortgage is nearly paid off, maybe fully paid. His equity is between $400,000 and $500,000, depending on the market he's in. Over 2 decades of rent. He's also generated net cash flow after every repair, every vacancy, every tax bill, every capital expenditure, and at least one significant renovation of somewhere between $40,000 and $80,000 in profit above what he spent. Marcus's portfolio, with his original $50,000, 20 years of $300 monthly contributions, and 10% average annual returns, has grown to approximately $420,000 to $460,000. His total out-of-pocket, the original $50,000 plus $72,000 in contributions over 20 years. No tenants, no repairs, no debt, both somewhere between $400,000 and $500,000. But they got there completely differently. Daniel worked for his wealth. Marcus waited for his. And here's the number that quietly changes everything. If Marcus had bumped his monthly contribution by just $200 more, from $300 to $500 per month, his 2-0-year portfolio jumps to roughly $550,000 to $600,000. Let me be clear. Real estate isn't a bad investment, it's a misunderstood one. And there are specific situations where it genuinely beats the stock market. If the rent-to-price ratio works in your favor, the general benchmark is that monthly rent should be at least 0.8 to 1% of the purchase price. If you buy a $200,000 property and can charge $1,800 a month in rent, the math is fundamentally different than the scenario we just ran. Cash flow is real from day one. If you treat it like a business, not a side project, landlords who screen tenants carefully, budget for capital expenditures from day one, build relationships with reliable contractors, and track every dollar those investors consistently outperform. The ones who wing it don't. House hacking. This is one of the most powerful plays in personal finance for young people. Buy a small multi-unit property, live in one unit, rent out the others. Your tenants essentially pay your mortgage sometimes. Your entire housing cost drops to near zero. The stock market cannot give you free housing. 1,031 exchanges. If you sell an investment property and roll the profits into a new property, you can defer capital gains taxes indefinitely. Over decades, that compounding tax deferral creates wealth that stock investors outside of retirement accounts simply can't replicate. Real estate wins when you're strategic, informed, and ready to treat it as a second job or a business. It loses when you go in thinking it's a passive income machine. Here's the honest takeaway from all of this. Daniel and Marcus didn't make good or bad choices. They made choices without the full picture. Daniel thought real estate was the proven road to wealth. Marcus thought the stock market would take care of him automatically. Neither one sat down and asked, what does this actually cost me? In dollars, in time, in risk, in stress. And that's the trap, not real estate and not stocks. The trap is making a $250,000 decision based on a YouTube thumbnail, a podcast clip, or what your uncle swears by at every family dinner. Over 20 years, both paths can build serious wealth. But only one of them matches your times, life, your schedule, your risk tolerance, your skills, your market, your goals. Before you pick one, ask yourself one question. Did I include everything? The full costs, the full risks, the full time commitment, the full tax picture, the full opportunity cost. Because the answer that includes everything is the only answer that matters. If you want to see what happens when you do both, when you own property times and times invest in index funds at the same time, that's a completely different conversation. And the math might shift everything we just covered. Drop a comment below if you want that video. Like this one if it gave you something real to think about. And subscribe if you want more of this. No hype, no shortcuts, Just honest numbers. I'll see you in the next one.